Welcome to this episode of the Raising Capital podcast and YouTube show. I'm your host, James Tuckerman. If you have not done so yet, make sure you hit that subscribe button so that you never miss an episode. And if you're listening to this or watching this on your phone, and if you have never given us a review, please take a minute to do just that. You'll be helping other people find this show, adding juice to the algorithms, and you will be helping us more than you will ever know. This episode is proudly brought to you by the B2B-Podcast Network. If you are a B2B business owner, B2B-.io helps you automate over 90% of the client journey via one sweet online platform. It's a funnel builder, it's a sales pipeline, it's a CRM all in one. You can use that to get more B2B clients and keep them forever. Now, today, I have as my guest John Winter, who is the co-founder and CEO of Superhero, which is an investment platform to make trading easier in Australia. And we can talk about Australia and international markets in a moment. He founded the business with Wayne Baskin in 2018, but Superhero officially launched in September 2020. And get this, in just over a year, it now has over 140,000 Australians using Superhero to invest both in Australian and US markets. Now, it was founded in 2018. It launched in 2020. And over the last 2 years, and I'm sure John's going to correct me if I'm wrong, I believe that it has raised 3 rounds of capital, one for 8 million, one for 25 million, and one for 15 million. The last 2 raises were both in 2021 within 6 months. John, how are you? Are you well?
Yeah, I'm great. Thanks for having me on today.
You're welcome. I want to know, when was the moment where you and your buddy Wayne went, you know what? Let's go out and raise money. Was there a moment where you just said, let's do this?
Yeah, look, there was. Sorry to correct you. The 8 mil was split into 2 and 6. So yeah, look, I think it was a really interesting time. I guess we started the business on the basis that we'd launch a superannuation product. Wayne came from an e-commerce background. He was an advisor to the board of Afterpay. I was a stockbroker. I was from the stockbroking industry. I listed Zip on the stock market, and through my career, I had a lot of those Zip early employees coming to me saying, I want to buy some Zip shares, but I don't have a huge amount of money. Can I use my super? So that was the thought starter. That was sort of the key trigger. And we started building a tech platform to really enable us to keep people's money within that the highly regulated superannuation environment, but give people that flexibility like you would have with a self-managed super fund. That's what the wealthy clients that I had were using to invest their money. But it's everyone sort of sub $500,000 in super that didn't have access to that.
So was that the narrative? The narrative was we're going to open up people's super so that they can invest like the top end of town.
Yeah, and the two parts to it was full transparency on where your super's invested, one of the big issues with super today, and the other piece was around control. So if you think about that whole investment management, investment administration piece behind the scenes, there's a whole sort of tech stack to run that. So we knew that if we wanted to succeed, we needed to build that ourselves from scratch. We couldn't go and white label someone else's. We don't really own our tech, and are we really a tech company? So to get that ball rolling, we knew we needed some cash. Wayne and I probably put close to $500,000 of our own money into getting the thing up and running, and then we pulled the trigger on a seed raise, which raised $2 million. And that was really sort of family and close friends that we got into there. And that was actually when we introduced Larry Diamond and Nick Molnar as initial seed investors into the business.
Well, just for fun, let's go back a decade, because a decade ago, you were launching a handbag brand or something, weren't you?
Yeah, I was.
What was that startup? You're an Antel magazine. What was it?
It was quite funny. It sounds really dorky now. It was sort of the early days of my career in stockbroking, I was working for, I think I was working for Macquarie Bank at the time, and looking to earn some extra cash on the side, and we saw a similar sort of product offshore, and thought, geez, that's actually a really good idea. The new iPhones were coming out. I think it was up to the iPhone 4 or something at the time, and
2013, yeah, that'd be about right. iPads were pretty much popular by then.
Yeah, something like that. So, but as we have today, battery life was always a killer. So my wife and I came up with this concept to build a handbag that had a charger built into it. So, in this like neat little women's clutch bag, it had a little cord that you can plug your phone in, and it was for Android or iPhone. And we actually went to China a couple of times, sourced all the products, everything, from scratch, and launched a crowdfunding round. And
wow. And then you realize that people can buy a charger and just keep it in their handbag.
Well, yeah, but we raised about $100,000 US on this crowdfunding site.
Wow.
And sold out of all these things. Like, I think we had 1,500 or 2,000 of them or something. And we sold out of them within a couple of months.
Well, that's one of the good things about crowdfunding, is that if you do have the product that you're going to sell at the end of it, it's really great for a consumer product like that, is that everybody gets their handbag and everybody feels good, which means that if you don't want to pursue it anymore, everybody's still going to feel good and happy about that. Yeah. I also just love it how, we hear about these overnight, entrepreneurial success stories. I don't know what the total dollar figure is, but like 45 million in 2 years. But the reality is a decade ago, you were raising $100,000 of crowdfunding campaigns. So it's the background experience. Yeah. So you were working at ZipPay.
I was a broker. So I sort of led the IPO of Zip on the stock market.
Right. And that's how you got to know the people from Zip.
Yeah.
And let's bring this back to that first round. Now, I got it wrong a little bit earlier. I think I said it was 8 million and you said it was 2 and 6.
Yeah.
Who was involved in the first two?
Yeah. So that really was the sort of the high risk, it was going out to family and friends and sinking our own money in as well, sort of, saying we're not quite sure how this will turn out, but just, back us. And in those rounds, we had family coming into it, but we had the founder of Zip come in. We had the founder of Afterpay come in. They're close friends of mine and Wayne's, respectfully. And I think the interesting thing, given the fierce competitive nature of those two businesses, it was always quite interesting because Wayne was sort of on the Afterpay side of the fence, I was on the Zip side of the fence. So we sort of agreed we wouldn't talk about Fight Club, and yeah, we haven't held a full sort of shareholder meeting yet where we've had everyone in the same room.
Well, Apple has shares in Microsoft, and Microsoft has shares in Apple.
Yeah, look, there's no, I don't think there's any issues there. Certainly not anymore. But it was always good for a good story over a beer.
So that's cool. So you started off with family, friends, and some people who were definitely not fools. You had some great personal connections. So that's a huge leg up when you've got some such big names. It obviously helps with credibility. How did you manage it? Oh, okay. My first question is valuation. So I don't know how much detail you can go into, but the tricky topic of valuation, it's always the biggest question when it comes to that first round. How are we going to value this? Were you positioning it based on where you want to be in 5 years or 10 years or 2 years or what the potential revenue upside was going to be? What were the main denominators that helped you determine valuation?
Yeah, look, I think that, early stage companies, it's really hard when you're pre a product. There's not even pre-revenue. You're pre having an actual product. It was a slide deck. So I think the way that we've always thought about it is, if this goes really well, how much of this company are we comfortable owning in 5 years' time, in 10 years' time?
Yeah.
Do we want to own a big chunk of it, or are we going to be diluted down to have 1% of the company that we're working so hard to build? So I think that's sort of where the angle we came from it. I think the experience that I had in sort of corporate advisory and share trading was a big help, but it's very different when you're sort of dealing with other people's money, dealing in these sorts of things, compared to being the person sort of on the other side of the table asking for money. Like that, it's a seismic shift. But look, I think you've got to put together a strong basis on why you think it's worth what it is, and be prepared to have the hard questions thrown at you if things don't go well. But you've got to back yourself to make it work.
Yeah, it's cool. It's a really tricky thing, that how much do I want to give up? And I've spoken to people and they're like, I don't want to raise barely any money because I want to own 90% of it. Now, the reality is that business 10 years later might be $1 million business of which they own 90%. Or they can end up owning 50.01 or 20% or 15% of $100 million valuation company, or a unicorn, $1 billion valuation company. So the other question I wanted to ask, that I always do like to ask, is the legal stuff. So you can put together a slide deck. Most of us can do that. It's pretty simple. You got your narrative sorted out. You know what your elevator pitch was. We're going to open up super funds for the masses, or whatever it was at the time. You've got your initial investors. What did you do next? Did you just go to a lawyer and get them to pull together a term sheet, or what did you do?
Yeah, so it's a really interesting point. I think it's a big point that a lot of startups miss, is the legal side of things is really important. So a lot of people go, yeah, that's an awesome name, Superhero. That's a great name. Let's try and get the domain name. So you go and get the domain name. We were really fortunate. We managed to get Superhero.
Yeah, you got it.
Yeah.
.com.au.
It's crazy. The next part is you got to make sure no one else is using that name. Right. So Superhero, there's been a decades-long battle between DC Comics and Marvel on who owns the word superhero.
That's hilarious.
Right. So there's all of these like little things you got to think about, and you've got to think about it, because if you launch a product when someone else owns the trademark, like you're either going to get sued, you're going to have to shut it down. You've put all this work into it, and now you got to change the name, and a lot of that sort of brand equity that you build goes. So I mean, we were fortunate enough to manage to get Superhero passed. We own the trademark for financial services.
I was just trying to find one of the older copies of Anthill magazine. We actually had a Superman on the front cover pulling open his shirt, and it had the word freemium on it. And yeah, we got the cease and desist letter from Marvel or DC Comics. I can't remember who it was. Very protective. Yeah. So you got to get your IP sorted out. This is before you've even begun to build the platform. You got to make sure that no one's trading of it, particularly no one's that's doing something similar to you.
And it's that IP that becomes valuable, right?
Yeah.
So like in the later rounds, we've got to put together, IP reports on, who owns what and how it's all held and all this sort of stuff. And it's like Nike. It's like Nike going to raise money, and they've got this great swoosh logo, but they don't own it. Someone else actually owns it, and they're breaching someone's trademark. It's actually not worth anything.
Yeah.
So it really is important. Moving forward, though, in terms of incorporating a company, that's almost the simple part.
Yeah.
But I guess putting together that term sheet is, it's the narrative that resonates with investors. It's what you're going to do, what you want to achieve, and then you sort of work back from there, right? So you want to achieve global domination. How are you going to achieve it? And then how much money do you need to achieve your goal? And the end goal in 10 years' time is probably not what you want to achieve off your initial seed round. It's what is this seed round going to enable you to do?
Yeah.
So that's how we thought about it.
Did you have a slide or something in your slide deck that said, this is what we're going to do with the first money, which is going to get us to here, and then we're going to raise, what was the second amount? 25 million or whatever, 6 million. Yeah, 6. And then once we raise that, we're going to get to here. And then did you have a slide like that, or was it?
I think in the thinking back, I think there was probably a slide that said, yeah, we'll raise $2 million. and we'll only need 1.5. And in the first 6 months, we'll turn into cash flow positive, and then we'll become a unicorn in 6 months or something.
Yeah.
Or something like that, like completely delusional. And I think it's, things always take longer than you expect. And they always take more money than you expect as well. But for us, it was interesting, we were trying to get this super fund stood up, and, anyone in the industry would know it is the most regulated space in the country. It is super hard to get, to move forward. You've got a lot of antiquated systems. You've got a lot of, super low risk people. There's a very low risk mindset. And, we were coming out with a pretty differentiated product where we're giving the control to the people. And, super funds have trained us to think that we are not able to manage our own money. It's like, you can't do this yourself. We are the professionals. Hand your money over. We'll take it from here, right? And by the way, we're not going to tell you what you're invested in. And yeah, we'll charge you, but we're not going to tell you what we charge. So it's kind of trained helplessness, right?
When you spell it out like that, it does sound kind of ridiculous.
Yeah, it is. But everyone accepts it because we keep getting told that that's the way we should be doing it. So, I think it was early last year. The pandemic had really started to kick in, and we'd built this entire platform that had a trading. It was a trading platform within a superannuation environment, and we didn't have the final regulatory tick to launch. And the pandemic's hit, and the markets have crashed, and then they've come roaring back, and there's this massive generational shift to valuing your money. How do I grow my wealth? People trying to add in additional income because they may have been laid off from work or hours cut back or whatever. And we said, well, we've got this trading platform. Let's launch it direct to the market. So out comes the pitch deck, and we're like, this is what we want to do. We want to launch Australia's lowest cost online share trading business. And by the way, this is how we're going to be have the highest gross margin business out there as well. So we've got a unique way that we've built our business model. And it was sort of, almost, it was a pivot.
So that was you already spent your $500,000 to build that thing.
We'd basically spent we had 50 grand in the tin.
So that 2 million was launched off the back of the platforms built. It there's a generational shift. I mean, there's a whole generation
after
of people.
the 2 million's gone, right?
That's after the 2 million.
That's after the two. So we've got 50 grand left. This is early last year. We've said we're going to pivot. This is what's happening in the world. We've already got the platform. This is how we're going to do it. This is how we're going to grow. And we told investors we're going to launch. We're going to get 10,000 customers on in the first 12 months. And there was probably some of that. We only need 15,000 to get to cash flow positive. And we tried to raise a couple more million. And all of those people who originally funded us, and a couple of others who we spoke to again, they were like, "Yeah, we're in." And we're like, "Okay, well, we can't have, we're only raising this much," and it came up to like $6 million. So we took all 6. So yeah, we're pretty fortunate. But I guess we sort of said this unlocks this much value. This is where we're going to get to. And everyone said, "Oh, you're going to get more than 10,000 customers." And we said, "Yeah, but that's our target. That's what we want to get in the first 12 months. That's where we want to get to." And we launched in September last year, and we got to 10,000 customers in the first 3 weeks.
Wow. Rather than a year, which then of course makes the next round of investment a lot easier to go from like 2 million to another 6 million, then a big 25 million.
Well, yeah, it was pretty interesting though. So we're live for 6 months, right? We got 10,000 in the first 12 months. I think we had 35,000 in Feb this year. And we've gone and spoken to a couple of massive fund managers. Like these guys run billions of dollars, and and they usually sort of greet you with absolutely no expression. It's just complete poker face. And we've got
poker face.
We've updated the pitch deck, and we're like, yeah, so this is this, and here we are, and this and that, and this and that. And all of a sudden, there's like $50 million worth of demand, and we're getting 25, and we're taking 25 million. It was like pinch me moment. I still can't.
Yeah. Well,
and they're like, "Oh, but do you have any historical financials?" I'm like, "Yeah, back to September." So yeah, it's been a pretty wild ride. It's really a number of things have sort of helped us along that journey.
So before we move on again, I've got two thoughts that have popped into my head. The first one is that how did you get those 10,000 people? What happened? What did you do? You kind of just launched a website and said, hey, everybody, I got a website. It doesn't work that way.
Well, it's actually great experience having sold a handbag with a battery charger in it. The way that we built up the demand for that product was just like pretty much purely just through PR. So it was all just, and thanks to Anthill as well. But it was like really, it was just like getting the product out there into the media. And my wife was she's a former publicist. She worked at Sweaty Betty with Roxy Jasenko. And she was like, no, this is how you get media. This is how we sort of take products to market. And I knew that when we launched this, we needed that PR impact. You need someone to tell the story. So we were fortunate to have the AFR cover us on the first day that article went live. I think it was the 7th of September, 2020. We had 1,500 people or 1,600 people sign up the first day.
You couldn't have picked a better brand for that, the Australian Financial Review. But it's also because it's also a very mainstream thing that you're doing. I mean, like the target audience is probably, anyone with a checkbook, really, anyone with a bank account and some money to invest. But the AFRs are a little bit better because it's clearly going to target those people that are looking for new and interesting ways to manage their money.
Yeah. Yeah, it was an interesting article as well. I think the title was, Zip and Afterpay founders back. Robin Hood of Australia, right? So it was just clickbait. Yeah, it was like it was. We couldn't have asked for anything more. And I think looking back on that day, we had no idea what we were in for. Like we had we had 500 emails asking us questions about the platform, phone off the hook. I don't even know how they got our phone numbers, but it was just mayhem. And I think that's sort of the joy of the roller coaster of what a startup is.
Yeah. Who's put together the FAQ page? We don't have an FAQ page.
The what? And it's, yeah, exactly. It's like
somebody put one together.
FAQ page, quick. So by that afternoon we had five points on our FAQ page.
So the other bit that I was interested in, so, when it's 2 million and then it's the other 6 million, these are largely personal relationships, or they might be relationships of the people that have already invested in the first round. When you're going up to the next round, suddenly we're talking about funds. So the first thing that I want to ask is that, were you the leader through all this, or did you find somebody to take your hand and guide you to help you when it came to raising the money, or were you just doing it yourself and learning as you go?
Yeah. So the first 8 million was, I led it all. And, I think I did have the advantage that, I reached out to former clients of mine. I did have a network that I could tap into who I'd been managing investments for in the past. So that certainly helped. I think the big thing though is, when that AFR article came out, the number of calls I got saying, "Oh, I want to invest in that as well." So people do have, they have FOMO, and it's that supply and demand. So raising capital, it's if you've got the demand, everyone wants in. If there's no demand, then people are, oh, look, I might take a miss on this. So it's really sort of hard to manage that. But yeah, on the 25 mil round, I actually circled back to my former colleagues at Shaw and Partners. They had a great relationship with some of these bigger funds. They charge pretty decent fees for the pleasure. But those introductions to those sorts of groups are priceless. So I guess that's sort of the foot in the door, but it comes down to your business model. It comes down to the people and what you've built.
Yeah, they're still not going to back you if they don't like it, but it sounds like all those different ingredients coming together and helping you with those introductions would have helped. I'm not sure if is there much of an interesting story that went with the next 15 million, or was it just simply that you were growing so quickly and you needed some extra money? What's the story behind that 15 million, or is that just an extension of the 25 million?
Yeah, so it was, we'd just raised 25 million, right? So this was like fast forward 6 months. I think we'd spent like maybe 5, probably a bit less. And we went out to 3 or 4 of these big investors and to give them an update on the business. And so how much money do you need? Was it no, we're just telling you about the stuff and the things that we're doing, and everything's going well. And they're like, yeah, so how much do you want? We're like, no, we're just telling you, the thing. And he's like, one of them in particular is like, you're not going hard enough. Tell us how much you need. Put the foot down. So all of a sudden it's like we're at 10 million, so we're going to raise 10 mil, and then the money's sort of flowing in, and it's like, okay, well, we've got 15. Like, what? What just happened? So yeah, I mean, it's sort of this, I guess, 2 ways to think about it. It was another round, or it was an extension of the first. But yeah, I mean, we've pulled in $40 million of growth capital in the last 6 months, which is like, I'm still pinching myself.
Yeah, it's crazy.
Got to work out how to spend it now as well.
I did see some names. Obviously, we've got the ones that you've mentioned from Zip. I also noticed that there's some other names like Fred Shabester, who's from finder.com. There's also a regular appearer, if that's a word, in Anthill. I think every time we have an award, he enters. Yeah. I think he's won once and got a couple of finalists. But were you particularly selective about the people that you were seeking? Are there people that you specifically turned away because they weren't quite right? Did you have an agenda of the type of people you wanted to speak with?
Yeah, so the early money, we set out, we said we didn't want any, and this is not to offend anyone, but we didn't want any dumb money. Yeah. We didn't want money for the sake of the money. We wanted people to invest, and those people to turn around and help us open doors. So whether it was introductions to other people, whether it was introductions to suppliers, whether it was how to scale, and obviously through the Zip and Afterpay relationships, they've built massive customer bases. So how do we tap into those lessons, those learnings, those people, the networks and things? So that was sort of the first chunk that we took, and I guess the 40 million that we've raised, it's really not just about. It's not just about the money now. When you start moving into those sorts of numbers, it's where's the next round coming from? How big is it? And who can help fund that? So I guess that's part of the consideration as well. So yes, very selective. There was a number of people who put their hand up, and it's family and friends as well, that we ended up having just to cut to literally to zero. And that they couldn't come in, and it's pretty hard to say to to mum and dad, and
sorry, Dad.
And they're sort
but
of
your son's going to be rich, so it's cool.
Yeah.
I'll buy you a Cadillac.
Yeah. So look, so it's hard turning people away, particularly when they're trying to throw money at you. But you do have to think about the strategic outcomes of the money that you take, and where the next check's coming from. You've got to always be thinking in the future.
So let's talk about that. I mean, like, where are you going with this? I mean, like, what's the $1 billion valuation superhero company look like? Is that the way you're thinking?
Yeah, look, I try not to think about the value of the business. I try to think about how can we, what money do we have, and what's the most efficient way to allocate that to growth? So, what the business is worth is based on the numbers that we achieve. So how do we build the numbers in the business as fast as possible? But yeah, it's a really interesting one. We have had discussions with others about, significantly larger rounds of capital. And the question is, so how would you spend the money? And
I think the next time we speak,
I actually don't know. Like
next time we speak, you'll be
good
all about M&As. You'll be M&A king.
Yeah.
You'll be like acquiring this business and this business and stacking them all on.
Yeah.
Leading up to,
it's even like 40
listing.
million. Like how do you spend 40 million bucks? So yeah, look, I don't
T-shirts.
know. We're having a
logos.
Yeah. Bus advertising. But look, I mean, we do have a pretty aggressive, expenditure line in the business model, and I guess we're sort of catching up to a number of our peers. We've only been around for 12 months, but really trying to get the name out there. And a couple of our peers who have been out there for 5-6 years, we've pretty quickly overtaken them, and there's a couple of others that we're nipping at the heels. So.
Well, I'll finish up with one question that I normally ask at the beginning. So it's a weird and a long-winded question, and it's you can go either way with this, and that is, what was the bit that you thought was easy and turned out to be hard, or what was the bit that you thought was going to be hard and it turned out to be easy? For those listening, John is thinking, he's contemplating, he's looking at the skies, he's doing his fingers like Monty Burns. No, he's not really.
I remember I went and spoke to Wayne, my co-founder. It was early 2018, and I said to him, "Oh, look, I want to come and talk to you about this idea, this business idea. I've been working on it for a few months, and I'd love for you to be a tech advisor." So he's had a look at it, and he's like, I'm in. I don't want to be an advisor. I want to be a founder. I'm co-founder. My email, he's like, "This is my email address. Set it up today." Like, he was in, like all in. And he's like, "Okay, where are you at with the tech?" I was like, "We've already started. We'll be live in 3 months." And he was like, "Yeah, okay. Something tells me that's not right." So it took pretty much 3 years to launch the product. So yeah, certainly thought that would be easier and quicker. But I think the way we have built it, it's pretty robust. What did I think would be harder? I think
finding a tech founder.
I think, well, you know what? It's actually pretty hard. So, a number of my friends and colleagues who have started businesses, they've said to me, they're envious because
it's really hard,
tech-based founder. So yeah, I'm pretty fortunate in having Wayne on the team. I hope he doesn't listen to this. I don't want to give him too much credit.
Yeah, no. I think he just turned the lights off on you.
Yeah, I think so. But yeah, look, that's massive. In terms of what I found easier that I thought would be harder is probably the capital side of things. Raising capital. We've been pretty fortunate with our investors being able to sort of bring the product to market and raise such a substantial amount of money in such a short period of time. I think it's credit to the model and to the team and what we've built. But it's a hard process for a lot of businesses, and certainly something that I've never taken for granted. But it has been a process that we've sort of worked through pretty efficiently.
Well, it sounds like it's been a wild ride, and I look forward to the next evolution. I'm enjoying your ads and your commercials and your PR. You seem to look like you know what you're doing, so thumbs up.
Right. It's the duck on the still water paddling very quickly underneath.
The legs beneath going absolutely crazy. Well, thank you so much for your time, John. This has been absolutely amazingly fascinating. Thank you.
Yeah, no, awesome. Thanks for having me on. Great to chat.